Okay, let's unpack this. We are diving deep today into a company that, if you asked most people what they do, the immediate answer would be profoundly unsexy.
Yeah, that's one way to put it.
We're talking about Packaging Corporation of America, ticker PKG. They make cardboard boxes. They make containerboard. But the investment community, the analysts, the sophisticated money, they treat PKG less like a cyclical industrial manufacturer and more like a high-quality compounder.
It is the ultimate paradox in the materials sector, isn't it?
Yeah.
When you look at the public comps, the stock is currently trading at a premium.
A huge premium.
Yeah, 21 times trailing earnings and nearly 12 times enterprise value to EBITDA. Now, contrast that with highly competitive peers like International Paper, that's IP, or the recently merged giant Smurfit Westrock,
SW.
right, SW. They often trade in the 8 to 9 times EBITDA multiple range. So the central question we really have to answer for you, the listener, is fundamental.
Why?
Why is a corrugated box company commanding this substantial, durable valuation premium?
Exactly. Our mission today is to understand what justifies this status. Is PKG truly the sovereign of the supply chain, running this perfect industrial machine, or are investors just, paying too much for the comfort of operational excellence?
Well, the initial thesis, built directly from our source material, argues the former. PKG is not merely a manufacturer of a commodity product.
Okay.
It is a highly sophisticated capital allocation engine. That's the key phrase.
A capital allocation engine, what does that mean in simple terms?
It means the management's rigorous internal discipline allows it to generate a long-term return on invested capital, the ROIC of about 16.5%.
Wow.
And that figure is critical because it is dramatically superior to its estimated cost of capital, which sits around 8.0%.
So that spread, that massive gap between 16.5 and 8.0, that's where all the value is being created.
That is the anchor of the whole argument. That 16.5% ROIC screams value creator.
Okay, but let me play the role of the skeptical investor for a second. Is that ROIC historically inflated by all the chaos of, the pandemic supercycle? Are we certain they can maintain that spread now that the growth environment has, normalized?
That skepticism is warranted. I mean, it's a very fair question, which is precisely why the next 2 years are so critical for them. They are currently navigating 3 incredibly complex strategic factors at the same time.
All at once.
Simultaneously. And how they handle these 3 factors will truly define whether that ROIC figure is sustainable for the long run.
Okay, tell us what those 3 factors are.
First, they are dealing with the macroeconomic environment, the painful, protracted end of the massive inventory destocking cycle, which everyone in the industry has dubbed the cardboard box recession.
Right, we've heard that term a lot.
Second, they are absorbing and integrating a massive acquisition, the $1.8 billion Grief Inc. Containerboard business. That's a huge bite to take.
A huge integration challenge.
And finally, and this is where the story gets really compelling, they are executing a strategic, friction-filled rebellion against a traditional, decades-old industry pricing mechanism. Successfully managing all 3 defines the entire investment case.
That sounds like a heavy lift. Let's start with that first factor, the market environment. We're calling this Section 1, Industry Dynamics, the Great Normalization.
Sounds good.
So the containerboard industry has been on a truly wild ride over the last 5 years. It's been characterized by extreme volatility between 2020 and 2025.
Oh, absolutely.
We had the initial frothy pandemic supercycle boom driven by everyone moving online where demand for e-commerce boxes just exploded. And that was followed by a massive and very painful crash.
That crash, which was the dominant theme throughout 2023 and the first half of 2024, was a textbook example of the bullwhip effect.
The bullwhip effect, can you just quickly remind us what that is?
Sure. Think of an actual bullwhip. A tiny flick of the wrist at the retail end creates a violent crack at the manufacturing end. During the supply chain crises of 2021 and 2022, every retailer, every manufacturer was terrified of running out of packaging. They massively overordered, creating this huge artificial demand.
So everyone was just sitting on warehouses full of stock, afraid of a shortage that might or might not come.
Precisely. Once the global supply chains normalized, and the economy began to slow down from its, post-pandemic sugar high, retailers looked around and realized they were sitting on mountains of corrugated boxes. Exactly.
Yeah.
And that realization led to aggressive inventory slashing.
Mm.
They didn't need to buy new boxes because they were just working through their massive stockpiles.
And this meant that box shipment declines temporarily decoupled entirely from broader economic activity. So the actual economy wasn't in a full recession.
Not at all.
But the box business absolutely was, because everyone was just destocking.
That's the key distinction. The cardboard box recession was inventory-driven, not end-demand-driven. But the good news, according to the sources, is that by late 2025, that severe destocking phase had largely resolved itself.
So we're past the worst of it.
We are moving into a necessary period of normalization and replenishment.
What does that stabilization look like in terms of, growth expectations? What are we looking at for 2026?
Well, analysts are projecting that U.S. containerboard demand should grow modestly at about a 1.5% compound annual growth rate KGR over the next 2 years.
Okay, so not a boom, but stable growth.
Exactly. But interestingly, production is actually projected to recover slightly faster, at 1.6% CGR.
Why the difference?
That faster production growth is essential to replenish those depleted supply chains back to healthy operating levels. So it's not the frenetic pace of 2021, but it is a welcome return to correlation with underlying industrial activity.
But PKG specifically flags some areas of uneven demand, which speaks to their specific market exposure. I mean, not all cardboard boxes are created equal, right?
That's a critical nuance. PKG specializes in high-value, heavy-duty packaging.
What does that mean?
Think large, durable, often moisture-resistant boxes used for industrial goods and bulk processed food. The source material highlights significant ongoing weakness in the beef and provolone segments, which are major customers for this specific, durable kind of packaging.
And why is that segment uniquely weak? What's going on there?
It's structural. Herd levels in the U.S. beef industry have dropped to 70-year lows.
70 years? Wow.
Yeah, due to drought and other production factors. So fewer animals processed means a corresponding structural reduction in the demand for those heavy-duty boxes used to ship large cuts of meat and protein.
So PKG has to offset this specific weakness somewhere else.
Exactly. They have to lean heavily on their other, more resilient verticals, like non-perishable food and durable goods, where their integrated scale provides a huge advantage.
So success isn't just granted by the end of the destocking. It's one market-specific discipline, knowing which customers to chase and, I guess, which to walk away from.
That's it. And moving now from demand stabilization to supply discipline, this is arguably the most significant structural development defining the industry's health moving forward.
And that would be the aggressive capacity rationalization across North America.
Yes, and we need to underline that we're not talking about temporary idling here.
Right. This isn't just shutting down a machine for a few months.
No, this is permanent structural capacity destruction. In 2025 alone, major North American producers collectively, though, independently removed approximately 9.5% of total capacity from the system.
9.5%. That is an enormous amount of supply taken out of a mature market in a single year.
It signals a long overdue maturity in the sector. Producers finally realized that persistent cost inflation, especially in energy and labor, made these high-cost older assets simply untenable.
So we saw competitors acting aggressively.
We did. International Paper permanently closed its mill in Orange, Texas, for example.
And PKG was right in the center of this with the Wallula rationalization. We mentioned this briefly, but let's go into detail on this strategic maneuver. What exactly did they shut down, and why was Wallula such a high-cost outlier?
So PKG permanently shut down the No. 2 paper machine and the adjacent expensive kraft pulping facilities at its Wallula, Washington mill.
Yeah.
Wallula was an outlier because it's located in the Pacific Northwest.
A high-cost region.
A very high-cost operating region. Fiber costs there are substantially higher than in the Southeast U.S. because those wood baskets compete fiercely with export markets shipping logs overseas.
And energy costs, too, I imagine.
Punitive. The regional energy costs were a major factor. The whole mill was just a drag on the entire PKG system's margin profile.
So they took 250,000 tons of high-cost capacity permanently offline. But they're a growth company. They can't just lose 250,000 tons of volume, right? How did that work?
They didn't lose the customer volume. This is the key. They engineered a system optimization. They strategically shifted that 250,000 tons of volume to their dramatically lower-cost flagship mills, specifically Jackson, Alabama, and Counce, Tennessee.
So they're making the same product just in a more efficient place.
Exactly. This makes their total network much more efficient because they are feeding customers from the most profitable asset base. And on top of that, The Wallula mill itself is being reconfigured to focus purely on utilizing recycled fiber, removing the expense of wood pulping entirely.
This sounds less like a shutdown and more like a precise surgical strike aimed at their own cost curve.
That's a great way to put it.
What is the expected financial outcome of this optimization? What do the numbers say?
The projected cost savings are staggering. PKG estimates that this reconfiguration will lower the internal production cost at the optimized Wallula mill by $125 per ton.
Per ton?
Per ton. That is direct margin expansion realized not through price hikes, but through pure, brutal operational efficiency. This move really demonstrates management's willingness to destroy volume if it's unprofitable, just to protect the overall profitability of the system.
And this leads to the massive implication for the entire industry. Operating leverage. If you destroy 9.5% of total capacity across North America, what happens to the remaining players?
It structurally tightens the market overnight. I mean, it is fundamentally transformational. Operating rates across the industry, that's the percentage of time the machines are actually running, were struggling in the low 80% range during the destocking phase.
Which is not great for profitability.
Not at all. But by the third quarter of 2025, after these permanent closures, they rebounded to above 93%.
That jump from, say, 85% to 93% might sound technical, but for a capital-intensive process industry like containerboard, that is the difference between mediocre profits and surging profits.
Exactly. In this business, the fixed costs, the capital expenditure, the debt service, the personnel, are constant. Once you get utilization above 90%, every additional ton produced leverages those fixed costs disproportionately.
It's all gravy at that point.
Pretty much. That rebound provides a fundamental pricing floor and immediately changes the leverage dynamic, moving power back toward the efficient producers like PKG.
So if we connect this to the bigger picture, the capacity cuts of 2025 mean that even if demand only grows modestly at 1.5%, the tighter supply basically guarantees better pricing power and significantly expanded margins for PKG as they move into 2026.
That structural setup is the foundation of their premium valuation, and it transitions us perfectly into Section 2.
Right. Understanding the durability of the competitive advantages that allow PKG to execute these complex maneuvers better than anyone else.
Exactly. Let's talk about the moat.
We established that PKG has an economic moat, categorized as a narrow to wide moat. It's powerful, but it's not protected by patents or some proprietary software. So how is this moat built? What's it made of?
It's built on physical barriers, cost advantages, superior asset quality, and just sheer scale. The bedrock of that moat is their extreme level of vertical integration.
Vertical integration.
PKG maintains an integration rate of over 90%. This means nearly every ton of containerboard manufactured in their large mills goes directly to their network of 93 box converting plants.
So they are not primarily playing in the volatile open market for raw board. They are selling finished corrugated boxes directly to end customers, the brands and manufacturers we all know.
And that vertical control acts as a powerful natural hedge against the industry's infamous boom and bust cycles.
How does that hedge work in a down cycle?
Well, let's look at a down cycle. When the open market price for containerboard is crashing, a time when non-integrated mills are hemorrhaging cash, PKG's box plants benefit from lower internal transfer costs.
So the input costs go down.
Right. This allows their box plants to aggressively compete on price, often stealing crucial market share from smaller, less integrated rivals who are struggling to source cheap board.
And when we hit a boom cycle, the opposite happens, protecting the profits on the mill side.
Absolutely. When board prices soar, which is fantastic for the mills capture that expanded margin internally. The crucial takeaway here is that this integrated structure smooths earnings volatility across the entire economic cycle.
And the market hates volatility.
Volatility is risk. And the market rewards PKG's ability to deliver consistent, smooth earnings, justifying that premium valuation.
Beyond smoothing the financials, there's also the non-monetary value of guaranteed supply chain control. If I'm a massive consumer packaged goods company, stability is worth a premium, right?
That supply chain control is a massive, tangible value proposition, especially for large customers. PKG can guarantee product supply even during extreme market tightness, like the panic buying of 2021.
While everyone else is scrambling.
Exactly. An independent box converter has to rely on that thin, volatile open market, and they often face shortages or huge spot price spikes. PKG eliminates that systemic risk for its key clients, ensuring customer loyalty and a stickiness that is nearly impossible for smaller players to break.
Okay, let's drill down now into the logistical nature of the product itself. Corrugated boxes are high volume, low value to weight. You are, as they say, shipping air.
That physical constraint is key. Because of that poor value-to-weight ratio, shipping boxes long distances is uneconomical and, frankly, environmentally senseless. A box plant's effective service radius is only about 150 to 200 miles.
So you have to be local.
You must be localized to the customer base.
And PKG's response to this is its network of 93 converting operations strategically placed across North America. This is where the concept of route density creates a massive barrier to entry.
Route density is the secret sauce for local economies of scale. Think of it like a national pizza delivery chain, say Domino's, versus a small independent shop in the same territory.
Okay.
Domino's can have multiple delivery stops on a single run within that tight radius, spreading the cost of the driver, the gas, and the fleet over more units. PKG does the exact same thing with boxes.
So they are maximizing the utilization of their fixed logistical assets, the fleet, the maintenance, the sales force, the distribution network, by making multiple delivery drops per truck run within that limited territory.
Precisely. This density spreads those high fixed costs over a higher volume of units delivered, resulting in a substantially lower cost per unit delivered compared to any fragmented or smaller competitor.
And this becomes a powerful, self-reinforcing competitive loop.
It does. A new entrant can't just build a plant. They must achieve PKG's entrenched route density and customer volume within that precise 150-mile radius to even be cost competitive. That challenge is often insurmountable.
So it's not just about the plant, it's about the whole network around it.
That's the real moat, and it's underpinned by the quality of its manufacturing assets. They operate some of the most efficient mills in the Western Hemisphere, located in optimal regions.
And that's the wood basket advantage.
That's it. Their flagship mills, like Counce, Tennessee, and Valdosta, Georgia, are massive craft linerboard facilities situated right in the heart of the U.S. South, which offers the world's best supply of abundant, high-quality softwood timber.
Which means their raw material costs are just structurally lower.
Inherently lower than those of mills located in, say, the Pacific Northwest or the Northeast.
And management is relentless about optimizing these assets, which brings us back to the Jackson, Alabama mill conversion, a classic example of strategic asset repurposing.
It truly is a case study. The Jackson mill was initially producing uncoated freesheet paper, which is a product facing secular decline due to digitization.
People just don't print as much anymore.
Exactly. But rather than letting it become a stranded asset, PKG committed $440 million to convert it to produce high-performance linerboard, aligning it perfectly with the secular growth of packaging and e-commerce.
And this one project added how much capacity?
700,000 tons of low-cost, modernized capacity. It demonstrates that management doesn't just manage assets. They proactively future-proof their entire system, ensuring every piece of capital is generating the highest possible return aligned with long-term demand trends.
Okay, so all these qualitative advantages, the integration, the density, the asset quality, they have to materialize in the financial statements to justify that valuation premium. Let's review the quantitative evidence. Put some numbers on this moat.
Let's address your earlier skepticism head-on. The numbers confirm the moat. If we look at the trailing 12 months, the TTM, the last 4 quarters, their return on invested capital remains strong at 12.6%.
And how does that compare to the competition?
It's not even close. International Paper's TTM ROIC is struggling at 2.5%, and Graphic Packaging, GPK, is at 9.0%. PKG is creating significantly more shareholder value per dollar invested than its peers.
That divergence, 12.6% versus 2.5%, that is more than a difference in execution. It signals a fundamental gap in asset quality and strategic focus. And that efficiency has to be reflected in their margins.
Absolutely. In the third quarter of 2025, PKG's packaging segment delivered an EBITDA margin of 23.1%. That is simply best in class in this sector.
23%.
Yep. Many competitors, weighed down by portfolio complexity and higher-cost legacy mills, are struggling just to stay in the mid-teens. PKG is structurally more profitable.
And finally, that conservative balance sheet, which they treat as a strategic weapon.
It allows them to play offense. PKG operates with conservative leverage, sitting at approximately 1.7 times net debt to EBITDA, even after taking on debt for the Grief acquisition.
And the peers are where?
They often sit between 2.5 and over 3.0 times. Low leverage is why investors view them as the sector's swan, the sleep well at night stock. This stability allows them the flexibility to maintain high capex for internal improvements, keep growing their dividend, and still execute opportunistic M&A during market turmoil.
This superior, stable financial profile is precisely what the market is willing to pay that 3 to 4 turn EBITDA to premium for. But now we turn to the riskiest, yet potentially most transformative element of the thesis.
The challenge to the established pricing mechanism.
Here's where it gets really interesting. For decades, the containerboard industry has operated under a system where contract prices were dictated not by the producer, but by an external index. It was a structural flaw just waiting for a crisis.
That external mechanism is the reliant on the fast market's RSI index. This index is designed to track open market transactions, essentially spot trades between mills and independent converters who are buying raw board.
So for generations, contracts were just simple pass-throughs.
Exactly. If NYSE reports a $50 per ton increase, your price goes up $50 a ton automatically, no questions asked.
That system worked when the industry was fragmented and the open market was robust, but the industry has consolidated massively, and PKG itself is 90% integrated. So what happened to the market that NYSE was tracking?
It withered away. As consolidation and vertical integration accelerated, the actual open market, the liquidity that NYSE is supposed to track, shrank to represent less than 10% of the total physical volume of containerboard produced in North America.
But wait, hold on. So the contractual pricing mechanism for 100% of the volume is being determined by trade data from less than 10% of the actual physical product. That's a massive technical disconnect.
It created the NYSE lag problem, which became absolutely punitive during the inflationary surge of 2024 and 2025. Well, PKG and its peers were hit with massive immediate cost inflation for everything: energy, chemicals, labor. They'd announced a necessary price increase, say a $70 per ton hike. But because the underlying open market was so thin and illiquid, the NYSE index often took months to move.
So their real-world costs are soaring, but their contractual revenue tied to that slow-moving index stays flat, leading to severe margin compression.
It cost them millions in lost margin. They couldn't contractually pass on their real-world cost increases until the index finally caught up, which was often 3 to 6 months too late. PKG management realized they were structurally operating under a mechanism designed to work against their profitability during inflationary periods.
That structural pain led to what the sources are calling a strategic rebellion.
That's the word for it.
PKG management has explicitly stated they are moving away from NYSE as fast as we possibly can.
This is a tremendous necessary pivot, an active attempt to seize control of their pricing destiny. PKG is currently engaged in the arduous, detailed process of renegotiating contracts with thousands of customers.
To what end? What are they moving towards?
They want to move away from index-linked triggers toward independent pricing models.
And what do these independent models look like?
They fall into 3 categories: true fixed prices for a set duration, which offer simplicity; cost-plus arrangements, where the price is directly linked to PKG's actual input costs, guaranteeing them a steady margin; or internal pricing indices that reflect the true current cost of providing a full-service, high-quality packaging solution.
This isn't just sending an email, though. You're talking about active negotiation with corporate procurement teams who rely on external, verifiable indices for auditing and control. That must be an intense, friction-filled execution challenge.
It requires immense commercial strength, and customers are naturally resistant. They like the stability and objectivity of a third-party price index. However, the stakes are what make this the most critical factor for the investment thesis.
So what is the high-stakes implication if PKG wins this fight and moves a majority of its volume off of NYSE?
If they succeed, they achieve a genuine paradigm shift. They would decouple their revenue entirely from thin spot market volatility. Their revenues would become inherently more stable, and their margins would be immediately and permanently more defensible against inflation.
It fundamentally transforms their earnings profile from cyclical industrial to quasi-utility.
That's the end game.
This raises an important question, then. If PKG successfully controls its pricing destiny, maintaining margin regardless of outside commodity swings, is that not the definition of a superior business model?
It is.
Does the market not have to reevaluate the risk profile entirely, granting the stock a permanent, higher valuation? The success of this pricing rebellion, in many ways, is the free call option for the stock price to move beyond the current fair value.
That's precisely the consensus of the bullish argument. You grant high multiples to predictable, inflation-protected streams of revenue. If PKG can prove that this decoupling is effective and sticky, They earn that utility-like multiple.
Okay, let's shift gears and assess how this machine performed recently, specifically in the immediate past, Q3 2025, which was a period of intense transition because of that big acquisition.
Right, a very complex quarter. Net sales came in strong at $2.31 billion, a healthy 6.0% increase year over year.
And what was driving that growth?
It was driven by two factors: continued successful realization of past pricing hikes and the initial partial contribution from the Grief acquisition.
But the crucial point of friction for investors was the earnings miss. They reported adjusted earnings per share of $2.73, falling short of the analyst consensus of $2.84. Where did that $1.11 miss come from?
It was almost entirely attributed to higher than expected operating costs. And those costs were related to two things: the complexity of the Grief integration and extensive planned maintenance outages at the newly acquired mills.
So they were spending money to fix up their new toys.
Basically, yes. PKG has extremely high operating standards, and they immediately took downtime, sometimes unexpected downtime, at the acquired assets to bring them up to their rigorous specifications. That short-term cost drags on immediate earnings.
It sounds like management is choosing pain now for long-term gain. They are sacrificing near-term profit for operational superiority and cost savings down the road.
That's their classic philosophy. Invest for the long term, even if it means missing a quarterly forecast. We also saw volume discipline in the quarter.
How so?
Legacy sales volume declined 2.9% year over year. This is management's discipline in action. They are willing to walk away from unprofitable volume customers, demanding prices that don't meet their internal hurdle rates just to protect their overall margin profile and pricing integrity.
They won't chase low-margin tonnage just to boost the top line.
Never.
Okay, briefly highlight the segment strength, particularly the often overlooked cash cow.
The packaging segment remains the core growth engine. It delivered $2.13 billion in sales with that impressive 23.1% EBITDA margin. But the paper segment, Boise Paper, is expertly managed for cash flow.
It operates in that uncoated free sheet market, which is in secular decline because of digitization.
Correct, but management treats it as a funding mechanism, requiring minimal capital expenditure or CapEx. It boasts a phenomenal 26% EBITDA margin high cash flow that they can immediately redeploy into the higher growth packaging side of the business.
We've established that disciplined capital allocation is the secret sauce. Let's review their inside-out philosophy, which prioritizes internal reinvestment first.
The numbers are staggering. Since 2017, PKG has deployed over $5 billion in CapEx, prioritizing essential maintenance and high-return internal growth projects that either lower their cost curve or improve customer service.
Can you give us a specific recent example of that modernization strategy in action?
The new Greenfield box plant in Glendale, Arizona, which opened in spring 2025, is a perfect illustration. It's a targeted investment designed to improve that route density we talked about.
Okay.
It replaces older, less efficient assets and doubles their capacity in the high-growth Phoenix market. Crucially, it allows them to service customers who were previously supplied from distant, expensive plants in California, dramatically reducing freight costs.
So it's a direct result of improving local economies of scale.
Exactly. And their investments are also essential hedges against structural macroeconomic shifts, like what's happening with energy projects. You mentioned the stress on power grids from data center growth.
Right, that's a huge new source of demand for electricity.
This is a new and profound inflationary pressure, particularly in the southeast U.S., where many of PKG's largest mills are located. The massive energy demands of hyperscale data centers, which often require gigawatts of dedicated power, are competing directly for grid capacity.
So it drives up prices for everyone else.
It drives up wholesale electricity prices for industrial users. PKG is seeing this cost coming and mitigating it by investing heavily in projects to make 3 of their major mills energy independent within the next 2.5 years.
How are they doing that?
Often through self-generation and waste energy initiatives. This CapEx is essentially an inflation hedge, ensuring their cost curve remains stable.
Okay, let's turn to the big external capital deployment. The Grief acquisition in 2025 for $1.8 billion. Why was this strategic, and how did they justify the price?
The Grief acquisition was highly strategic because it filled a specific product gap. It included 2 key mills, including one in Riverville, Virginia. That mill produces semi-chemical medium.
What is that?
It's a specific grade of board used in container construction, where PKG was previously structurally short. This acquisition enhances their system completeness, giving them full control over their entire input mix.
And financially, it was the classic accretive arbitrage maneuver.
Absolutely. PKG paid approximately 6.6 times LTM EBITDA post-synergies for those high-quality assets. When your own stock is trading at roughly 11 times EBITDA, buying comparable assets at a 6.6 times multiple is highly accretive to shareholder value.
It's an instant financial uplift.
A huge one.
We mentioned the Q3 earnings miss was related to integration friction. What are the long-term specific synergy expectations that investors need to watch for?
The integration friction was real. It involves not just systems integration, but replacing old components and optimizing logistics. However, the company expects to realize $60 million in run rate synergies.
And where do those synergies come from?
They're primarily driven by logistics optimization, integrating the Grief plants into PKG's superior red density network, and benefiting from procurement scale in chemicals and fiber. The realization of that $60 million is a key monitorable for 2026.
And the conservative balance sheet supported the deal beautifully.
It allowed them to maintain stability. Even after financing the $1.8 billion with about $1.5 billion in new debt, their pro forma leverage remained highly conservative at approximately 1.7 times net debt EBITDA.
Wow, that's low.
It's very low. This ensures they maintain flexibility for future investments and, crucially, supports their substantial, consistently grown $5 annualized dividend, which provides a yield of about 2.4%.
Okay, no company, even one with this level of operational discipline, exists without headwinds. Let's look at the secular challenges PKG faces, starting with the biggest environmental trend: plastic substitution.
Right. The secular tailwind of fiber replacing plastic, the environmental movement driving brands away from the non-recyclable materials, is directionally positive.
Yeah.
We call this the call option because it represents potential new growth categories.
Consumers want paper, not plastic.
Consumer preference and new regulations, especially in Europe, are pushing major brands toward fiber packaging.
But you describe it as a slow burn, not an explosive growth driver. Why the tempered enthusiasm?
Because it's currently a marginal contributor rather than a transformative wave. Paper still faces significant physical limitations compared to sophisticated plastic films, particularly concerning moisture, grease, and oxygen barriers.
Things plastic is very good at.
Very good at. So while PKG is well positioned in areas like food service where these barriers are less critical, the technical limitations mean the shift is incremental, not immediate. It's a long-term benefit, but it won't double PKG's sales next year.
The other major headwind is the maturation of what was their largest growth engine for a while: e-commerce.
E-commerce growth, which once exceeded 20% annually, is normalizing to a still healthy 7% to 9% annual growth rate. The market is maturing, and the headwind within that channel is the concept of right-sizing.
Which means getting rid of shipping error.
Exactly. Explain right-sizing further because it directly impacts PKG's volume.
Right-sizing, often called the empty space problem, is a volume headwind. Companies like Amazon are deploying advanced AI and packaging algorithms to significantly reduce the empty space inside boxes.
The box shows up, and it actually fits the product.
Imagine that. And furthermore, they are pushing ships in an own container, or SIOC protocols. This is where products are packaged robustly enough at the factory level to ship without an extra outer corrugated box.
So you're eliminating a box from the equation entirely.
Right. Both actions reduce the total square footage of corrugated board required per dollar of gross merchandise volume sold. PKG has to aggressively counter this volume pressure by ensuring they are selling higher value, high-performance board.
The kind that can withstand the rigors of the SIOC shipping environment. It becomes a value for volume trade-off.
Let's discuss the financial risks beyond secular shifts, starting with the constant battle against input cost volatility.
PKG is fundamentally a spread business. They buy fiber and energy and they sell packaging. Their acquisition of Grief increased their exposure to recycled fiber, specifically old corrugated containers, or OCC, the recycled waste paper.
And OCC is volatile.
Highly volatile. A sharp spike in OCC prices could significantly compress margins at their recycled fiber mills. Coupled with the structural energy inflation we already discussed, driven partly by data center, demand input costs remain a constant threat to profitability.
And there's the ongoing external litigation risk facing the entire sector.
Yes, the tail risk is the class action lawsuits alleging price fixing among major containerboard producers, including PKG, IP, and WestRock.
How serious is this?
Well, these suits are standard in concentrated industries, and outcomes are uncertain, but a significant adverse judgment or settlement could impact cash flows and introduce reputational damage. It's something that has to be monitored.
Despite these risks, we circle back to the massive valuation premium. PKG trades at 11.8 times EBITDA 3 to 4 turns above the peer average of 8 to 9 times. Why are investors so willing to pay up for this company?
They are paying the price for operational safety and superior ROIC. Investors are buying predictable, expert execution, and a management team proven capable of allocating capital profitably across cycles.
So it's a sleep well at night stock.
PKG's internal drama is minimal compared to peers dealing with constant restructuring or debt issues. It is simply the highest quality, most stable name in a difficult sector.
So what does this all mean for the listener considering the stock near $209? The post-destocking recovery trade has already happened. Is there upside left?
Based on our intrinsic valuation, a detailed discounted cash flow analysis, assuming a normalized weighted average cost of capital, or WACC, of 8.5% and 2% terminal growth, our models suggest a fair value of $225 per share.
That means the stock is essentially fairly valued, offering only about 8–10% upside based on normalized expectations. The consensus rating, therefore, is a firm H-hole.
It's a great company, but the market knows it. Fresh capital should probably wait for a pullback to get a better margin of safety.
And, crucially, that $225 target only assumes successful normalization and execution of synergies. It does not fully factor in the potential paradigm shift from the pricing rebellion.
Correct. That success is the upside lever, the free call option you mentioned earlier.
Okay, let's wrap this up.
To summarize this deep dive, Packaging Corporation of America is the paragon of operational excellence in the cyclical industrial world. They have proven they can surgically rationalize their system, as demonstrated by the Wallula closure, while simultaneously executing aggressive, accretive M&A like the Grief acquisition.
And they're engaged in the most fascinating strategic pivot in the industry, the aggressive move away from the unreliable, illiquid RISI pricing index to take control of their own revenue stream. This is the critical test of their current premium valuation.
So for you, the listener, navigating PKG in 2026 requires monitoring 3 key execution metrics.
First, successful on-time realization of the full $60 million in Grief synergies. Did those integration costs successfully convert into permanent profits? That's question number 1.
Second, hard evidence that the estimated $125 per ton cost savings from the Wallula optimization are actually materializing and flowing directly through the bottom line, widening their margin spread.
And finally, the critical transformative metric. What percentage of customer contracts have they successfully moved off the RISI index? Is the rebellion working, and how sticky are those new pricing structures?
PKG is a quality compounder, but the stock is priced for constant, near-perfect operational execution.
So we leave you with this provocative thought. If PKG achieves structural price independence by decoupling entirely from that illiquid RISI index, they gain the ability to pass on inflation in real time. Does that not fundamentally transform PKG from a cyclical industrial stock, beholden to commodity movements, into a durable, inflation-protected utility?
And if so?
And if so, should the market grant them a permanent, even higher valuation multiple, perhaps into the high teens EV/EBITDA range, to a company that controls its own pricing destiny? Something to mull over as you keep an eye on those monitorables.
That's a wrap on this deep dive. We hope you feel a little more informed about why a cardboard box company is one of the most interesting and sophisticated investment stories on the NYSE.